Good morning again. Mark Conter here with the Messer Financial Office. Thank you again for joining us on this summer day. This morning again, we're going to bring to you information on another one of our carriers' products so that, again, you'll be better equipped as you go out into the marketplace to assist your clients in their life insurance needs. A couple of little housekeeping items before I get started. Ask you all again to place your phones on mute. If for any reason you hear any background noise that's coming from your office, make sure you are muted out. Again, please do stay with us until the end. That's where we'll review any questions that you have, and again, announce any bonuses attached to the products being presented today. Again, this morning, with ProtectiveLife, we have Mr. Stephen Gowowski, and he is the internal wholesaler. And it's been a pleasure having Steve with us before. And so once again, Stephen, thank you very much.
Thank you, Mark. Good morning, everybody. Today, what I'd like to do is just go over a couple of the riders that are on several of our products, most of our products that draw quite a bit of interest. So again, my name is Stephen Gowowski. I'm an internal wholesaler here for Protective. I work Messer Financial Group as one of my accounts. So I'm always available to help out. So I'm starting this presentation. The first one we're going to go over is called our Extend Care Rider. Okay, and what this is here, it's a chronic illness acceleration death benefit rider. It acts like an LTC rider. So what we do here is we specify a monthly benefit amount between $1,000 and $10,200. It's up to a maximum of 5% of the death benefit. So the rider is available only at issue up to age 80. Now it's going to be separately underwritten. I'm going to get into that here in a little bit, but it can be issued at a maximum of a Table 4 rating. So 100% of this death benefit may be used for chronic illness benefits. The minimum death benefit is $100,000. The maximum death benefit is $5 million. So we have two elimination periods here, a 90-day and 365. I would say 99% of the cases I work on, we use a 90-day elimination period, but we could use a 365 just if we wanted to lower the premium a bit. So each benefit period is 1 year. We're going to get more into that on the next slide as well. So qualifying event here, you have to be certified as being chronically ill within the past 12 months. What does it mean to be chronically ill? Unable to perform 2 of 6 ADLs. So here's really a key point of our rider. It's indemnity payment method style. So what does that mean? No receipts are required. There's no limits on the use of benefit payments. So we tie this to HIPAA. So HIPAA right now says the maximum is $10,200 monthly. That's what we use. And again, we have the indemnity style, so you do not have to provide receipts, which you have to do with several other carriers. So again, additional underwriting here requires cognitive testing and information containing ADLs. And this will all be handled by the examiner at the time of the paramed. Oh, I'm sorry, I lost the page here. So we're going to go here as to how it works. So the client is going to pay their premium. So here we're buying a policy with the Extend Care Rider. So the beauty of this is somebody's going to get paid on this eventually, right? So either we're going to use all of the monies as the Extend Care benefit. We may use a combination. They may use some Extend Care and then have some remaining as a death benefit, or they may never use that and just use the death benefit, or just leave it all as a death benefit. So next rider I'm going to go into here is called our Income Provider Option Rider. This is a rider that doesn't get used a lot, but really has kind of a uniqueness to it. And I'm going to talk about really the situations where we see this used quite often. Okay, so this rider here, what it does, it basically works like an annuity payout of the death benefit. So what we do is we have the ability to spread the death benefit anywhere from 2 to 30 years. And by doing this, we get a significant premium discount sometimes. And the reason being is, for example, let's just say we have $1 million death benefit. and the premium comes back at $20,000, and we need to lower that premium. Well, by using the IPO rider, what happens is we're going to spread out the death benefit. So by doing that, we may say, okay, let's let's pay out $500,000 upon death. The other $500,000, we're gonna have $50,000 payments for 10 years, which is $500,000, plus the original $500,000 lump sum gives us $1 million. But when we take that back to a present value, it may be $700,000. So why is the premium lower? Because now we're actually underwriting for a death benefit of $700,000 instead of the original $1 million that we were looking at. So again, I'm going to get more into some examples here, but just kind of want to give you a general overview. So again, this rider is available only at policy issue. So it saves money again by applying a discount factor to the initial policy face amount. So this discounted face amount is used to determine all policy rates and values. Now there's a $10 monthly minimum income payment. I've never seen it that low, but that is the minimum, is $10. $10 a month. So while this policy is in force, it works like a general policy, meaning that they can take loans or withdrawals. That's all available. Now, of course, all this will have a pro rata effect on all the policy values. So here again, now we can make part of the death benefit lump sum in addition to the income stream, or we can say we want all of the monies paid out as an income stream. So it's really whatever we want to choose from here. So several choices. Now, as obviously if we're paying, so again we have $1 million, and if we're taking zero out as a initial lump sum, we're going to pay the $1 million out over anywhere from 2 to 30 years. When we do that scenario, we're going to get the increased savings. The premium will drop more via that way. So additional planning opportunity here is we can have different beneficiaries for the lump sum and differing income streams as well. So we can get pretty creative with this. Now, we can even specify the date of payment for the income stream. Someone's birthday, a holiday. That's where I've seen this recently used. Is we had a grandmother who wanted to buy some life insurance, and ultimately she wanted the monies to go to her grandkids. So she structured this. She had, I think, 5 grandkids. So she structured this to give each of her grandkids on their birthday for the next 15 years $25,000. So this payment each year upon her death, the death benefit will be paid out over 15 years, and it'll be paid, their check on their birthday each year for, like I said, for the 15-year period. So it kind of leaves a legacy planning gets used for as well. Now the one issue here is because we're setting this up like an annuity, there's an exclusion ratio on the income payments. Part of the payment is considered taxable as taxable income. It may or may not be taxable, but it is included. They do have to include it in their taxable income each year. So I'm going to give a couple examples with this one. So here we have a 68-year-old female. She applies for preferred, comes back at standard. So when she applied for preferred, a $2 million death benefit with our Advantage Choice UL, which is our guaranteed UL, we had an annual premium of just under $40,000. Went through underwriting, came back as standard. So now that annual premium is $48,616. So a little over $8,600, the premium increased. So we're trying to get back to the original just under $40,000 premium. So a couple solutions we have here. So of that $2 million, we can say let's pay out $750,000 as initial lump sum. Then we still need $1.25 million, right, as a payout to get to $2 million. So we're going to say let's pay $50,000 a year for 25 years to the beneficiary. So again, that's our $2 million total. We come up with a premium of $38,186, actually lower than when we started at preferred, which was almost $40,000. Another idea here is we can say, okay, upon death, let's pay the beneficiary $500,000. So we still have to come up with $1.5 million. So here, to get to $1.5 million, we say let's pay out $75,000 a year for 20 years to the beneficiary. Again, our $2 million total. We come up with almost the same premium, $38,245. And I would say this is where I see it get used quite a bit, is when somebody applies, let's say at the standard, and they come back with a table rating, the premium increases. We're trying to get back to that original quoted premium at standard. and this is one we use this quite often, is spreading out this death benefit. Another sales idea I have here is we're going to use the income provider option to offset the cost of the Extend Care rider. So we're going to get the Extend Care rider basically free by using the IPO. So here I have a 50-year-old male, preferred non-tobacco, looking at $1 million of the Advantage Choice UL, death benefit guaranteed to age 95. So I have an annual premium of $8,636. Now, if I add the Extend Care rider to this at $9,900 a month, I now have an annual premium of just under $9,500. So we want to get back near that $8,636 annual premium, right? Which was without the Extend Care. But we want to add the Extend Care, but like I said, keep that premium kind of low, or at least where we originally quoted. So what we're going to do is use the IPO rider. So in this scenario here, we're going to pay out $400,000 lump sum to the beneficiary upon the death of the owner or the insured. Then to get the additional $600,000, we're going to say we're going to pay out $30,000 annual payment for 20 years. That's our $1 million total. Final premium comes in just under $8,500, which is actually $130 lower than the original premium without the Extend Care. So those really are the main uses I see. Like I said, I've seen it used for legacy planning where, like I said earlier, the grandma wanted to leave a legacy for her grandkids. The other main use is come back different than applied for. Applied as standard, comes back a table rating. And the other example I've seen, haven't seen this used a lot, but actually an agent of mine, his brother was an insurance agent years ago, and he bought a life insurance policy. He was a younger guy, bought a life insurance policy for $1 million. This is before they had these payouts like this anyway. He passed away unexpectedly, so his wife received a sizable death benefit at that time. And over about a 5 to 10 year period of time, she went through all the money, and now she's, I guess, living pretty tough off of this now, but she basically squandered all the money he had at that time. So it's a nice thing to use just for money management, that someone receives a decent sum of money up front and then basically receive a annuity for up to the next 30 years. Mark, that's all I have on my slides today, so I'm going to turn it back over to yourself, and any questions anybody does have, I will definitely answer.
Great. Thank you very much, Stephen. Okay, ladies and gentlemen, so once again today, just keep it simple and sweet for you. A couple of extended riders or Extended Care and the income producer rider available, again, only at the time that the policy is issued. And of course, with the Extended Care rider, looking at the cost that will be increasing the actual premium, how the IPO rider, again, can help disseminate some of that cost and keep it within reason. Looking at the information here today, Stephen, you touched on the potential for a taxable consequence. I don't know if you can go back to that slide or kind of give us a little bit of in what circumstances might that payout become a taxable event when everyone is so familiar with income or taxes or benefit of a death benefit being a non-taxable event other than business type of insurance plans?
Yeah. I'm sorry, Mark.
Well, that's it. That's that last bullet down below there.
Yep. So what happens when we run this illustration? We're going to show the amount that will become taxable. So, like I said, the exclusion ratio will say, hey, 80% of this is excluded, 20% is going to be taxable as income. And the way it's really going to work here is like I said, let's just say we had $1 million death benefit we originally applied for. And then we're going to say that, we had to get the premium down, so we're going to spread out the payment, right? So we're going to do this annuity style. And when we do that, we now are going to underwrite for $750,000, right?
Right.
So we're now underwriting for $750,000. So when we're underwriting for that amount, it obviously the premium's lower at $700,000 than it is at $1 million. That's how I get the savings. But then they're taking that $250,000 and they're going to spread that out over how many years we make that payment and say this is going to be taxable income. Just IRS code on that.
Okay.
Our illustrations will all provide that. The illustrations we have, which I think do a great job. The early pages of these will state in there, what that exclusion percentage is. And like I said again, you have to remember it may or may not be taxable income. So it's included, or it may not be taxable. I'm sorry. It will be included in taxable income. Whether or not they pay taxes, obviously, is dependent on their taxable situation. Did that answer it pretty well?
Yeah, that helps. And so the best part of it, though, is if there is that potential, it is going to show up in the illustration. So it's not going to be a blindsided situation for the agent to present to the client.
No, it will not. It'll show early in the illustration. And to hit on that point, I've seen some pretty significant savings, using this, where we, like I said, we applied it standard, came back table rating, and we needed to get back in that ballpark. So generally, the owner, the insured, the one making a payment needs to get the life insurance, they're budgeted by a certain amount, needs to get back to that original budgeted annual premium amount that they were able to pay. So it kind of offsets, that later on down the road, the beneficiary is going to, may have to pay taxes or will include as taxable income. So usually the benefits, outweigh, but again, it is something to think about.
Okay. Also, too, you touched on the fact that, of course, these two riders are not available on all products. Are we safe to say they're available on all permanent products?
Yes, sir. Yep.
Okay.
They're not. Our custom choice UL product, which is now, you basically can just use it for term now. You used to be able to do guaranteed, it was a GUL lifetime guarantee as well product. Now it can just be used for term. So yes, it's not available on that product.
Okay.
But the income provider option is. So the IPO rider is, but the extended care rider is not.
So any
permanent product. Yep.
Yeah. Any term product, we can exclude that extended care rider from possibility.
Yes.
Okay. And check and see if we have any other questions on our board here. And I don't see any. So once again, ladies and gentlemen, please take time to perhaps run yourself a quote on our quoting tool. If you need assistance with the permanent product quotes, you can get a hold of us. Stephen is also in your corner, so we can get those done if we get an overload of demand. Also want to make sure, obviously, you need to be appointed. So go to our Messer website and go to our contracting tool under Agent Resources and take care of your contracting and appointment with Protective. Also, I'd like to bring to your attention again this morning that if you're able to bring us a application for life insurance with one of these new riders on top of it, we will also entitle you then to an additional $100 bonus on your commission for that sale. Only one per agent. Again, only agents that are on the webinar this morning. So for your colleagues that weren't available to take the time this morning, they won't get that opportunity to pick up that extra C-note. Also, make sure that your E&O is up to date. You can do that also on the Messer website, again under our Agent Resources tab. And also like you all to know, of course, that the Messer Expo will be taking place again this year on September 12th and 13th here in the Charlotte area. If you haven't seen the information, you'll start getting bombarded with it shortly. And Stephen will be with us during that expo. We're looking forward to that. And I don't have any questions coming up. So, Stephen, once again, thank you very much for your time, for the presentation of information.
Anytime. Thanks. Thank you, Mark.
And again, ladies and gentlemen, have a great day today. We'll talk to you or see you on the webinar next Wednesday morning again at 9 o'clock. Thank you again. Signing off.